Okay, what's the risk for some of the stakeholders involved in crypto lending? First, let's look at the investor or depositor. Okay, so for them, because they deposit the money or deposit the crypto in the lending pool, there's obviously the credit risk of borrowers. The good thing is that that risk can be priced in with a diversified pool of borrowers. Okay, so there are borrowers from all over the world, essentially, right? The chance that the investor lose all their money because one borrower does not repay the loan, that chance is very small. So essentially, it works the same way as the traditional lending. The banks issue the loan at a scale to a lot of consumers. So it's really diversified. So their risk is very predictable at the end. And another way to manage the credit risk of a borrower that the borrowers are required to over collateralize their loans. That means for every $100, the borrower can only borrow $50 or $75, depending on the crypto protocol or the exchange. Okay, so that leaves a buffer in case the underlying crypto price drops, say 20%, 25%. The collateral still is valuable enough to cover the loan in case the borrower goes into default. Okay, so it's actually very similar to the home equity loan, right? So if you build up a home equity, that's your the value of your property minus your outstanding loan. Then the bank can issue a loan based on the equity. But again, what they learned from the 2008 financial crisis that they will not issue 100% the loan based on the equity. They will only issue maybe 70%, 60%. In case the property drops 30%. So that's the credit risk of borrowers that can be managed. That's not a huge concern, right? Because you have the collateral and you believe that the exchange and the protocols, they are doing what they are supposed to do, right? When the price really falls that much, so they will liquidate the collateral, okay? Let's look at some other risks. For investor and the depositor, if there's exchange involved, there's an intermediary, right? So there's a risk with exchanges. Exchanges are running a business. The business could fail, or there could be some insider jobs, some bad actors. For example, maybe the owner, they take your crypto and run away, disappear, right? That happens. And hacking. So the hackers, naturally, they will target all these exchanges, trying to steal the money. There's no difference from what they are trying to do with the traditional financial institution, right? They try to steal the money from the bank all the time. So there's a risk with the exchanges. If there's no exchange, there's still risk with the protocols, right? Because the protocols are essentially the computer programs. There are programming mistakes because they are written by people, right? People will make mistakes. Now, one example is that for Compound, in late September 2021, there's a software upgrade, protocol upgrade. Then there's over 160 million comp tokens. They were basically free to grab due to a mistake. The good thing is that that amount is relatively small. But think about if that mistake is 1 billion, 1 trillion, so what would happen, right? And also protocols can also be hacked, right? There's a risk there. And also remember, whether exchange or protocol, they are not regulated. So there's no insurance by the federal agency like FDIC for the bank deposit. Okay. if you want to minimize risk, there are private insurance you can go to, right? But that will also lower your return. Let's move on to borrower. So what are the risks for borrower? One is obviously the market risk. Okay, so if the crypto price tanked, right, decreases so much, which has happened quite a bit. If, for example, the collateral factor is 75%, the crypto price dropped to 75%, then the exchange usually will have a margin call, ask you to put in more collateral. And if you don't have those, right, you cannot put in more assets, then the exchange or the protocol will automatically liquidate your cryptos in order to cover the loans. In that case, you lose the crypto. The crypto price increase, but you are betting the price will go down. So obviously you are losing money from your trade, right? So there's market risk driven by the fluctuation of the crypto price. Then obviously there's operational risk with the exchanges, with protocols we just talked about, right? So you put your cryptos there, but they could be gone, right? So due to the different events. Okay, what about the exchanges? Okay, do they have some risk? Yes, they do. First is the operational risk, because they assume the custody responsibility. There is a possibility that they fail that responsibility, right? Whether it's an insider job or we talk about the hacking. And also there's a market risk, right? So the crypto, they are willing to engage in the lending. So they have to assume a certain volatility, right? That's how they calculate the collateralized factor, but there's a chance that they under-calculated that, right? So for example, the collateralized factor, let's say it's 75%, but the crypto suddenly dropped 50%, so very quickly. So there's no time for exchanges to have the margin call. It's possible that there's no time to even liquidate because the whole market is dumping that particular crypto. So then the exchange will experience a loss. Then there's a regulatory risk. So remember, right now, these businesses, they're not regulated if they are not forbidden by the local governments. So the regulations are coming, right? We all know that all the new things, new fintech, they are playing a game of regulation arbitrage. Okay, the regulation is always lagging, but they will come eventually. So when that comes, that will naturally increase the operational cost for exchanges. Even more serious, that could impact the whole viability of the whole business model. Okay, there's a regulatory risk. Last but not least, I want to briefly touch upon the regulator. Okay, so the regulator, their job is to avoid system risk. Okay, so the challenge for them is that they need to strike a balance between consumer protection and encouraging the innovation. Okay, that's at least that's the thought process for regulators in the US. In some other countries, we know already this type of crypto lending has been banned already. Okay, so consumer protection risk. So if we only have crypto lending for those existing crypto holders, right? We talk about the native cryptos. Then the potential risk is relatively small. Okay, that's why the regulator they do not forbid cryptos altogether in the first place. But however, as we talk about, in order to instill liquidity in the lending pool, so you need to give the investor, depositor the confidence that their holding will hold the value, right? That's the reason we see the introduction of a stable coin. So that the derived form of cryptocurrency draws a lot of people into the crypto lending. Okay, so now you have the connection of the native crypto trading as well as the mass market consumers. That really gets the regulator concerned because there are more opportunities to go wrong, and if something is wrong, the implication is pretty wide. That's why you see the drama between the Coinbase and the SEC. Then if there is a stable coin, then are there any reserves, right, behind the scene to back it up, right? So who is there to prove that reserve is adequate? Then there comes the regulation of the exchange. So that's worth another topic to talk about, okay, stable coin and regulation. Okay, let's do a quick recap. So we talk about what's crypto lending. It's a lending based on crypto. Okay, it's also a form of secure lending. Why people participate in crypto lending? As an investor and depositor, they are after the returns. For borrowers, they want to access to cash, or they want to access to crypto for some other business objectives. Okay, they hope to earn money by utilizing that crypto. So what's the risk of crypto lending? For depositor, investor, there's a credit risk, maybe not so much from the borrowers directly, more from the exchange or from the protocol. For borrower, what's more important is the market risk. Okay, the crypto price goes up a lot or goes down a lot, depending on your positions, you could lose quite a bit. For exchange, there's more operational risk, right? So there's a hacking, bad actors. How do you safeguard the crypto, fulfill your custody responsibility? There's also regulatory risk, right? For regulator, what they are concerned is more the system risk. Is it possible that the crypto trades linked with the regular consumers, right? Some are not so sophisticated, so they want to avoid that. Okay, so that's a high-level introduction of crypto lending. I hope you find it informational and useful. So what are your thoughts about this new form of consumer lending? Have you participated in the crypto lending? So what's your experience, especially during the different phase when crypto price tanked a lot in the past 6 months? Please comment below and share your opinion. If there's more interest about the stablecoin, I probably will do another video. Thanks for watching.